Hi there! Buying a restaurant involves more than agreeing a price. Let's explore Goodwill, stock valuation, and key UK tax considerations.
The hospitality sector operates on razor-thin margins and relentless pressure. A flawless dinner service requires exact timing, precise ingredients, and zero room for error. Now apply that same operational rigor to buying the business itself. You have negotiated the purchase of a highly profitable UK restaurant for exactly £1 million. But that top-line number is an illusion. Overlook the interplay between VAT, stamp duty, land tax, or how intangibles are amortized, and your upfront cash requirement immediately inflates. The 2026 UK tax landscape is aggressively unforgiving for hospitality transactions. A single misaligned clause in your purchase agreement can trigger compounded tax penalties that cripple your cash flow before you even open the doors. This is the Atlas Tax Advisor's Corporate Compliance Playbook. We engineer the tax architecture behind premium hospitality acquisitions. The most consequential decision you make happens before you look at the financials. The initial legal wrapper you choose, buying the shares of the company versus buying its underlying assets, dictates your tax efficiency, capital allowances, and exposure to historical risk. Mastering this specific legal architecture is the exact difference between a highly profitable acquisition and a permanent financial liability. Every M&A deal begins with a structural conflict. Sellers inherently want to sell their shares. Buyers, to protect themselves, require an asset purchase. In a share purchase, the buyer acquires the issued share capital of the target limited company. For the seller, this is a clean exit. The transaction proceeds flow directly to the shareholders, entirely avoiding double taxation at the corporate level. Sellers push aggressively for this route to access business asset disposal relief. This relief effectively drops their capital gains tax rate to just 10% on the first £1 million of lifetime gains. But a share deal places the buyer at an extreme disadvantage. You are acquiring the intact corporate entity exactly as it stands, completely inheriting all of its historical liabilities and compliance failures. In the hospitality sector, these legacy risks are severe. You take on exposure to historical furlough claim audits, Section 455 tax charges on overdrawn director loan accounts, and retroactive national insurance assessments for mismanaged trunk-tip distribution systems. An asset purchase bypasses this trap. Instead of buying the company, you selectively extract the specific business undertakings you actually want, the kitchen equipment, the commercial lease, the brand identity, and the liquor licenses, and place them into a clean, newly formed company. The target's old corporate shell, along with its entire tax history and potential litigation risks, is legally left behind with the seller.
To insulate your capital from the target's past operational mistakes, you must aggressively negotiate for an asset purchase. Once you secure an asset structure, you have to value what you are buying. In a successful restaurant, the physical equipment is only a fraction of the price. The largest slice of the purchase premium is typically Goodwill. This covers the restaurant's brand identity, its trading reputation, and its established customer lists. Prior to April 2019, companies could easily write off this Goodwill against their corporate tax bills. Now, the Corporate Intangible Fixed Assets regime, under Part 8 of the Corporation Tax Act 2009, strictly governs this relief. The current law imposes a rigid gatekeeper requirement. You cannot deduct any amortization for Goodwill unless it is acquired as part of a transaction that includes qualifying intellectual property, such as a registered trademark. Even if you acquire qualifying IP, the statutory mathematics are capped. The allowable tax basis for your Goodwill is strictly limited to 6 times the value of the acquired intellectual property. Returning to our £1 million acquisition, if you allocate £200,000 to Goodwill and buy a registered trademark valued at £10,000, your deductible Goodwill is capped at exactly £60,000. The remaining £140,000 of Goodwill receives zero corporation tax relief. It becomes a permanent accounting add-back. Failing to explicitly value and itemize qualifying IP in your sale and purchase agreement renders your largest asset premium mathematically worthless for tax relief. Beyond intangibles, prime brick-and-mortar locations dictate restaurant margins. Transferring commercial leases or freeholds introduces an entirely different tax interaction. Commercial property sales are normally exempt from VAT. However, if the landlord has executed an option to tax to recover their own historical renovation costs,
the property transfer automatically triggers a standard 20% VAT charge. This creates a compounding trap regarding stamp duty land tax. Stamp duty land tax is calculated on the VAT inclusive price of the property. If VAT applies, you are forced to pay progressive tax brackets of up to 5% on top of that 20% VAT surcharge, artificially inflating your tax bill. The required structural intervention here is treating the transaction as a transfer of a going concern, or TOGC. This special status places the sale entirely outside the scope of that, which immediately shrinks your SDLT exposure back to the base property value. Securing TOGC requires meeting strict mandatory conditions. Both the buyer and seller must be that registered. The buyer must continue operating the same kind of business, and crucially, the buyer must formally notify HMRC of their own option to tax prior to the completion date. Perfectly engineering a TOGC election is non-negotiable. Missing a single requirement results in a massive upfront cash flow hemorrhage and a permanent, unrecoverable stamp duty penalty. With the property secured, we turn to the physical, operational assets inside the kitchen. Structuring the deal as an asset purchase allows you to establish a step-up in tax bases. This means you can claim higher future capital allowances on the acquired kitchen equipment and dining room fit-outs. These expenditures are categorized into distinct statutory pools. Standard plant machinery, like commercial ovens, falls into the main pool, which now attracts a 14% writing down allowance. Integral building features, such as industrial HVAC and extraction systems, are restricted to the special rate pool at 6%. Next is the transfer of trading stock, the raw ingredients, wines, and spirits. Under HMRC's business succession rules, both parties must default to the fair market value of the inventory, unless a specific commercially viable price is explicitly negotiated in the sale and purchase agreement. Finally, there is the human element. While an asset purchase acts as a firewall against corporate tax history, employment law pierces straight through it via the Transfer of Undertakings Protection of Employment Regulations, known as TUPE. Under TUPE, if the business continues to operate under the same trade, all employees transfer automatically to the new buyer. Their continuity of service, accrued holiday pay, and existing contractual terms are completely preserved. You assume full liability for these operational obligations from day one. To manage this, the law dictates a strict timeline. The outgoing employer must provide comprehensive and accurate employee liability information exactly 28 days prior to completion. An asset purchase protects your capital from the target's corporate tax history, but you fully inherit the operational and human realities of the physical business. Every restaurant acquisition requires restructuring a highly volatile matrix of tax profiles. The menu and the physical property are merely the starting points. A secure asset acquisition rests on 4 mandatory pillars: executing an explicit IP allocation in the SPA, electing for TOGC to neutralize property taxes, correctly pooling capital allowances, and ensuring strict TUPE compliance. This framework reflects 2026 and 2027 UK tax legislation. As statutory rates and rules evolve, this playbook does not constitute formal, individualized financial advice. You must model the precise tax consequences of your deal structure before you sign any heads of terms, not after. To ensure your next hospitality acquisition is meticulously engineered, fully compliant, and financially optimized, contact Atlas Tax Advisors today.